just for fun, watch this. Okay. So if I highlight all these again, right, the value is 9,181. So if I'm not discounting any value at any rate, right, watch what happens. So I'm going to go here. And what if I make this 0? What happens? See? It's the same thing. If I didn't have to pay interest on that, right, if I didn't use a discount rate, then that 91A1 is net present value today. Okay, Control Z. Okay, now watch this. Let's pretend that our rate was a lot higher, right? So this is telling us our target price, I'll get here in a second, is 22 bucks, okay? Assume orange is what we're looking at. 22 bucks is our target price. Watch what happens if our rate goes from 14 to 20. Do you think our target price is going to go up or down from 22 bucks? What do you think? Right? If our interest rate is higher here, that means that we're a riskier company. So that would mean our target price should go down a lot. And it does. We went from 22 to 13. Okay? So you Control Z, go back, 22 to 13. Now watch this. Let's pretend we're a much better company, right? We're, actually, let's just take the beta. If I take the beta and cut it in half, watch what happens to the interest rate here. Goes down to 8.4%. We're a lower risk company, right? And then let me ask you this. If our beta is 1, which means our interest rate is lower here, our blended cost of capital interest rate, what happens to our target price? What happens to the free cash flows? Well, the value of these free cash flows is going to be a lot higher because our interest rate is lower now because our beta is lower. So let's look at NPV first, see what it calculated, and then we'll go down to our target price. So NPV before was 5,000 something. Watch this. It's now 6,000, close to 7,000, right? It went up because our cost of capital went down a lot. And our target price went from 22 bucks and that orange cell to much higher, 46. Look at that. Unbelievable. Okay. All right. So let me just undo that. Go back, make sure all this is cleared. All right, good. Great. So we've got our net present value, right? And again, that's all the future cash flows discounted using the rate we calculated into today's terms. Okay. And then you're like, well, hold on, Chris, this doesn't make sense because why are you assuming the company is valued off of these cash flows as well? I mean, only, but what would happen if like the company operated for a long time, like for infinity? And then, the answer there is you're right. You're right. We have to account for the year 2021, 2022, all the way up until like forever, right? So how do we do that? Well, that's called the terminal value. It's kind of a dumb name. Terminal value. All right. So we have to calculate what the terminal value is. And once we find out what that terminal value is, right, it's right here, right? It's basically in this year, you can take all the future cash flows discounted to this term. You have to discount that one big number to today. So let's do it. Yes, first try. Okay, so our long-term growth, the company, this is an assumption. What's the long-term growth of our company? Well, it's 2%, right? And I gave that to you. And you could say, well, wait a second, Chris, how do you know the long-term growth rate of the company is 2%? That's pretty low. I'm sure some companies will grow much faster than that. Well, the answer is no, they don't. And it's not their fault. They just got too big, right? And big companies just can't grow unless they buy other companies, right? And use their own cash. And so, or shares, whatever it is. So if you think about the US economy, and I mentioned this before, the US economy is massive. It's 25% of the revenue of the world. And the revenue of the world is just gross domestic product. So 25% of the world's market cap, so to speak, is or revenue is the United States. And the United States, because it's so big, it just can't grow, right? It can't grow anymore. It's huge. It's kind of like IBM. IBM doesn't really grow as much. In Oracle, ticker ORCL, it's not growing as much because they're just big, mature companies because they're successful. They just got big. And so that's why companies like Oracle buy a lot of other companies just to grow, right? And that's a little off topic, sorry. But anyway, so our long-term growth rate is 2%, right? And I've seen numbers that are 2.5%, 3%, whatever, and as low as 1%, right? If you're bearish on the company longer term, meaning you're looking to short it, just assume 1%. And we'll play around with these numbers in a second. Okay, so our long-term growth rate is that, right? And our terminal value is this calculation. You ready? All right. What you do is this. You take our final year, 2020, you grow it one more year, which is 2% growth, and then you divide it by the cost of your capital, which was 14.31%, minus the growth rate. Okay. Let's go up here and take a look, see what's colored. That. So you're taking your final year, you're growing it one more year, which means 1 plus the growth rate, which is there. Okay. And then what you're doing is you're dividing it by this interest rate minus the growth rate, which is 2. Okay. Hit enter. And that's the terminal value, right? So in the year 2020 or so, right here, or 2021, whatever, right around this level here, your terminal value is all future cash flows, right? Using the long-term growth rate and the weighted average cost of capital, right? And then you're like, well, hold on a second, you got to discount that as well, right? So we did it. We discounted by 4 years. We took 33.8, which is right here, right? 33.8, discount 1, 2, 3, 4. Actually be 4 because it'll be right here. Okay, there. All right, so that is what you got. Now watch this. If the long-term growth rate went from 2 to 3, and I'm going to hold this down so you can see this as well. Watch this. 3. Right. It's now, terminal value is 37. Okay? Pretty amazing. If it was 1, watch what happens. Our value goes down, right? Because our long-term growth rate is lower. And the reason I want to pull this up here is because this is a sensitivity analysis. I'll get to it in a second. But I want to show you I've got growth here and weighted average cost capital. What happens if I increase or decrease our discount rate? And what happens if I increase or decrease our growth? What happens there, right? And you'll see in a second, okay? Okay, now, what is the value of our company based on all that research? Well, let me just take this off here, sorry. So the value is going to be the target equity value minus debt, right? And target equity value is that, right? Plus net present value, right? So that's these years here, that's the NPV we calculated. And then right here in infinity, that's terminal value, right? So those two values, right? Boom, boom. And that's already discounted. Minus debt, which is de minimis, it's only 10 bucks. And that's the target value of the company, right? And the number of shares is there, right? Got it from there. Watch what happens if we have only 100 shares. Boom, much higher. So that's what I mean. Play around with these numbers a lot, okay? I really want you to understand finance and not memorize it. It makes it so much more fun too, okay? You'll find most of your competitors will just memorize this stuff. They won't really understand it. And I wrote here, what's the target price per share, assuming a weighted average cost of capital of 11.5%. I should actually say 11.3, sorry. 11.3% and a long-term growth rate of 3, right? And the math here is, it looks complicated, right? I know it's complicated, right? But it's basically just everything we've done, right? It basically says, well, the value of the company is going to be the net present value, right, of those cash flows, plus the terminal value discounted as well, right? Minus the debt we have, right? Divided by the number of shares, okay? And if you didn't divide by the number of shares, what happens is it's going to give you the target market cap of the company, right? If that's the target market cap of the company, market cap, member is just shares times the price. Watch what happens. If I go here and divide it by 1165, which is the number of shares. Whoops, I screwed that up. Sorry. I go here, divided by 1165. 33.47, right? There it is, 33.47, okay? Got it? And so remember here with our terminal value, right? You divided it by the discount rate minus long-term growth rate. And you might say, well, hold on a second, Chris. What if the discount rate is less than the growth rate? It never will be. It never will be, because in the long run, companies can't grow more than a couple of percent, right? All right. Okay, so if we go here, we play around with these numbers, you're like, Chris, I disagree. I'm going to have 4% longer term. Type that up. Look what happens. All these numbers change, right? Okay. And then watch this. If you're like, okay, Chris, I get it. You've got all these levels. You're deducting kind of 300 basis points here from each one. That's, when they say 300 basis points, they mean 3%. A basis point is 0.01 of a percent. 100 basis points is just 1%. It's just nerd finance talk. Okay. You can play around these numbers. But this is awesome. So portfolio managers love this stuff, right? Because, you know, a lot of times they'll disagree with you when you do a model review with them, right? When they look at your model, you're like, well, they'll say, Chris, I don't agree with your rate. And you're like, okay, that's cool. look, here's the sensitivity analysis. I have a bunch of other rates. And they'll say, well, I don't agree with your growth rates, long term, I mean, not the discount rate. And you're like, oh, okay, is that what you meant? Well, look at this here. I have the different growth rates. And so what I always do is I love to look at this table because there's three different cases. Remember Goldilocks and the three bears, right? There's this one's too hot, this one's too cool, this one's just right. So I usually take this as the base case target price, okay? And that's the bullish target price, and that's the bearish target price, okay?